Welcome to the Deep Dive, your essential shortcut to being well-informed on the latest market movers.
Today, we're diving deep into Clover Health's second quarter 2025 earnings call.
Yeah, this one dropped after market close on August 5th, and it gave us quite a bit to chew on, actually.
It really did. You've got a company growing fast, membership's up, but also facing some, let's say, familiar pressures.
Exactly. So we're going to unpack the financials, look at management's whole technology-first strategy, and figure out what this updated guidance really means.
And also, why did the market react the way it did? Because that was pretty telling. We need to balance the good stuff against the challenges.
Right. Okay, let's jump in with the headline numbers first, because on the surface, things looked pretty decent.
I can say that.
They reported a GAAP earnings per share of -2 cents. That actually beat the consensus, which was looking for -3 cents.
Okay, so a small beat there.
And revenue came in strong, too. $477.6 million. That was better than the $468.3 million expected.
And quite a jump year over year, right? About 34%?
Yeah, 34.0% growth year over year. Solid. And adjusted net income and adjusted EBITDA both landed at $17 million.
Okay. So on paper, like you said, looking pretty good. Beats on top and bottom lines, decent adjusted profit.
But, and there's always a but, isn't there?
Usually. Despite those beats and, management sounding generally positive on the call, the market reaction was, well, not positive, quite negative, actually.
Yeah, sharply negative.
Which tells you immediately, okay, growth is there, sure. But investors are worried about something else. Profitability, costs, something deeper.
That reaction is exactly why we need to dig deeper. It's not just the headline numbers.
And there is.
The real story is in the details, in the trends, and what management is saying about the future. Let's get into it.
Right.
So first, that growth. Insurance revenue specifically, $469.8 million, up 34.3% year over year.
Strong.
And average Medicare Advantage membership, MA membership, grew almost 32% year over year. Reached over 105,000 members.
So they're definitely pulling members in. The model works for acquisition, clearly.
Right. But the big question, can they handle that growth profitably? Does it scale without costs ballooning? That's the core tension.
And we'll get to the cost side in a second.
Looking at profitability, the GAAP net loss was $10.6 million. Now, that is actually an improvement, about $4 million better than last year.
Okay, so moving in the right direction on GAAP loss.
And adjusted SG&A selling general admin costs came in at $82.5 million.
How does that look as a percentage of revenue? That's usually the key metric for efficiency.
Good point. It was 17.3% of total revenue. That's down 280 basis points, or 2.8 percentage points from last year.
Okay, so that's actually pretty significant. It shows good operating leverage. They're getting more efficient as they grow.
Exactly, spreading those fixed costs better.
So you have this real contrast building. Growth is strong, efficiency on the SG&A side is improving, but then you get the medical costs. And this is where the story takes a turn.
This is the number I think that really caught the market's attention. The insurance benefits expense ratio, or BER.
Yeah.
It came in at 88.4%.
Which sounds high. Or maybe low. What's the context?
Well, the context is the change. It was up 12,230 basis points year over year.
Wow. Okay, that's a huge jump. Over 12 percentage points higher.
Yeah. It means a much bigger slice of every premium dollar they took went straight back out to cover medical services compared to last year.
And that's what likely spooked investors. That kind of increase raises serious questions about underlying cost control and future profitability, even with the SG&A improvements.
Precisely. It overshadows the other positives to some extent.
It really does. Can their tech model, the Clover assistant they talk so much about, actually bend that cost curve if the BER is jumping like that? That's the million-dollar question for you listening.
Before we get to the tech, just quickly rounding out the financials. Cash and investments looked okay, $389.3 million.
Solid balance sheet footing then.
Yeah. And they did mention days in claims payable decreased by 5 days to 32 days. So claims processing seems to be normalizing after some industry hiccups.
Okay, good operational point. But like you said, probably didn't move the needle much given that BER number.
Right. So the balance sheet's fine, but the focus is squarely on that medical cost trend.
Which brings us to management strategy.
Yeah.
How are they planning to tackle this? They lean heavily on their tech.
They do. They kept emphasizing their technology-first model, their AI-driven clinical recommendations.
The Clover Assistant platform.
Exactly. They believe that is what drives their above-market growth and will ultimately lead to sustained adjusted profitability.
Do they offer any proof points on that? Beyond just saying it.
They did mention a new white paper on COPD patients. It apparently showed using Clover Assistant correlated with 15% fewer hospitalizations and 18% fewer readmissions.
Okay, I mean, if that's accurate and scalable, that is significant. That could genuinely lower costs.
That's the hope. That's the core thesis.
So what's their roadmap, sort of their strategic arc?
They laid it out in phases. Phase 1, achieve profitability. They claim they did that in 2024 on an adjusted basis.
Okay.
Phase 2, which is now, 2025, return to growth while keeping that profitability. They think they're doing well on that front despite the BER pressure.
Debatable maybe on the sustaining profitability aspect if costs are rising, but okay.
And then phase 3, the goal for 2026. Use their tech model to accelerate both growth and profitability together.
The holy grail, basically. Grow fast and make more money doing it.
That's the plan.
And they're also trying to sell this tech to others, right? Counterpart Health.
Yeah, good point. They highlighted Counterpart Health, which is their way of offering Clover Assistant to other groups that take on insurance risk.
Like other health plans or maybe provider groups.
Exactly. They mentioned a strong pipeline of deals, even a pilot with independent pharmacies. So they're trying to monetize the tech itself, not just use it for their own members.
That's smart. Diversifies revenue, validates the tech if others are willing to pay for it.
Definitely part of the longer-term vision. But, healthcare doesn't operate in a vacuum. What about the industry backdrop?
Right.
Regulations?
Right. Always crucial.
Management acknowledged they are seeing some higher cost trends in their Medicare Advantage book. They're not immune.
What's driving that specifically?
They pointed to supplemental benefits and also Part D drug costs, linking it partly to the Inflation Reduction Act changes kicking in.
The IRA impact. Yeah, the whole industry is watching that closely, especially on the Part D side. It's putting pressure on margins for many plans.
They said they're monitoring it closely. It's kind of an unknown variable still.
So that's a headwind. What about regulatory tailwinds? Anything positive?
Well, they sounded pretty excited about a new initiative from CMS and the White House focused on health tech and interoperability.
Okay. How does that help Clover?
They think it aligns perfectly with what Clover Assistant is trying to do, patient-centered connected data. They even said it could turbocharge their access to data.
Interesting. More data could definitely fuel their AI models. But again, that sounds like a longer-term potential benefit versus the immediate cost pressure.
That's the trade-off, isn't it? Okay, let's talk guidance. What did they actually tell the market to expect for the rest of 2025?
This is where things get really interesting, mixing the good and the, less good.
On the plus side, they raised their MA membership guidance, now expecting 104,000 to 108,000 members.
So continued strong growth expectations.
Yep. Insurance revenue guidance was kept the same, $1.80 billion to $1.875 billion.
Okay, maintained.
Adjusted SG&A guidance was improved. They expect to spend less now, $335 million to $345 million, more operating leverage.
Better efficiency baked in. Good sign.
And adjusted EBITDA and net income guidance also maintained at $50 million to $70 million.
So membership up, efficiency improving, overall profit target stays the same. Sounds okay so far.
But here comes the kicker, the insurance BER guidance.
Let me guess, it went up.
It went up. They raised the full-year BER forecast to 88.5% to 89.5%.
Oof. Okay, so they're explicitly acknowledging those higher cost trends will continue through the year.
Exactly. They mentioned the Part D and supplemental benefit trends, and also just the cost pressure that comes when you add a lot of new members quickly. Their costs haven't stabilized yet.
And that guidance change, raising the BER forecast, is almost certainly what drove the negative stock reaction. It signals weaker underlying profitability than maybe hoped for, despite the other metrics.
Makes sense. But what about 2026? They kept pointing to 2026 as a big year.
Yeah, that was a major theme. The catalyst is their expected move from a 3.5-star rating payment year in 2025 to a 4-star payment year in 2026.
And just quickly, star ratings from CMS directly impact how much Medicare pays these plans, right? Higher stars mean more money.
Exactly. It's a huge deal financially. Jumping from 3.5 to 4 stars means significantly higher base payments and potential quality bonuses from CMS.
So they see this as a major financial tailwind coming.
A massive one. They expect it to structurally lift both revenue and margins in 2026. It's kind of their light at the end of the tunnel for the current cost pressures.
And they also mentioned sticking with wide network PPO plans while others might be pulling back.
Right. Positioning themselves as offering broader choice, which could also help attract members, potentially justifying that growth, even if it comes with near-term costs.
Okay, so summing up the situation. Good growth, better efficiency on SG&A, but rising medical costs are hitting the BER now. Management says, trust the tech and wait for the four-star boost in 2026.
That's pretty much it in a nutshell.
So let's connect that to the investor reaction. The stock drops over 20% the day after this call on heavy volume. Why such a disconnect?
Well, it looks like a classic sell the print situation. Management is painting this picture of AI prowess and a big 2026 payoff. But the market, right now, is laser focused on current medical cost trends. That raised BER guidance for this year overshadowed everything else.
So future promises weren't enough to overcome present pain.
Pretty much. Analysts like UBS cut price targets, specifically citing those margin pressures from the higher BER. And you have to remember the context. The whole healthcare provider sector, the IHF ETF, hasn't done great over the past year. Investors are jumpy about costs.
Yeah, sensitivity is high.
So for Clover, showing they can actually control medical costs and hitting those star ratings, that's paramount. The market wants proof, not just projections, especially for 2026.
That 2026 catalyst sounds potentially huge, but like you said, it feels far away when the BER is rising now. How do they bridge that gap for investors?
It's tough. They need catalysts sooner rather than later. What could move the needle?
What do you think, Aaron?
Well, any updates during the year that give more confidence in achieving that four-star rating would help. Showing strong execution in the second half of this year, sustained adjusted profit, and crucially, signs the BER is stabilizing or even ticking down, that would be huge.
Real proof points from Clover Assistant actually saving money.
Exactly. Tangible, quantifiable results from the tech, maybe from counterpart health deployments too. And then there are always macro factors like overall MA utilization trends surprising one way or the other.
So the story really hinges on proving cost control soon and making that 2026 star boost feel more like a certainty.
I think that's fair. Credible cost containment now, confirmation of the uplift later.
All right. That brings us nicely to our This Is Not Financial Advices segment.
Yeah, that's the fun part.
Okay, so we have a stock here, Clover Health. It beat revenue estimates, beat EPS estimates, grew membership strongly, improved SG&A efficiency.
Sounds great so far.
But it also raised its full-year medical cost ratio guidance, the BER, which promptly tanked the stock over 20%.
The whiplash.
Right. And management is heavily promoting this AI tech story and a big expected financial boost in 2026 from that four-star rating. So for you, the savvy, risk-tolerant listener, what kind of speculative idea could you cook up here?
Okay, this is definitely speculative, remember that. But given this whole dynamic, the near-term pain versus the potential long-term gain, how about a kind of barbell strategy?
Intriguing. Explain.
Well, you're acknowledging both sides. The market's current skepticism, but also management's potentially powerful 2026 story. So, two parts.
Part one?
Part one is a short-term bearish play. You could use options, maybe selling some near-term out-of-the-money calls and perhaps buying some further outputs.
Okay, so betting that the stock might struggle or even drift lower in the next month or two, capitalizing on that negative BER sentiment.
Exactly. It respects the market's current focus on costs and protects a bit if things get worse before they get better. It's a nod to the immediate pessimism.
And part two, the other end of the barbell.
Part two is the long-term bullish leveraged bet. Here you'd look at Apius long-term equity anticipation securities. Specifically, deep-in-the-money call options that expire way out, like late 2026 or even early 2027.
Ah, so this is the bet on the 2026 turnaround, banking on the four-star rating and the tech paying off.
Precisely. The deep-in-the-money aspect gives you exposure, similar to owning the stock, but with the leverage of options. If that 2026 story does play out as management hopes, the upside could be significantly amplified.
So you're essentially short-term cautious or bearish, but long-term very bullish.
Kind of. It's an asymmetric bet. You're saying, okay, market, I hear your concerns now, but I'm willing to place a leveraged wager that management's longer-term vision, especially that 2026 boost, will win out.
Highly risky, obviously.
Extremely risky. It requires that four-star catalyst to really deliver. But it directly plays the tension we've been discussing, the 2025 cost noise versus the potential 2026 structural improvement. For someone willing to handle the volatility, it's an idea.
A very interesting, if high wire, idea. Okay, let's wrap this up.
We've covered a lot of ground.
Yeah. Clover Health, definitely showing impressive growth. Membership numbers are strong. The tech story is compelling.
The benefits expense ratio, the BER, and the updated guidance clearly poured some cold water on things, led to that big market drop.
Right. The core tension seems crystal clear now. It's the near-term medical cost pressures versus management's confidence in their AI and that big 2026 four-star tailwind.
Absolutely. And for you listening, the next few quarters are key. Can Clover Assistant actually start to visibly bend that cost curve? Can they stabilize or improve the BER? That's what investors will be watching.
And remember, everything we've discussed today is based on the earnings call and market data. It is absolutely not financial advice.
Leave to your own research.
We hope this deep dive gives you a better framework for your own thinking, though. As you consider Clover Health, what stands out to you? Is it the tech potential, the cost concerns, that 2026 catalyst? What's the biggest hurdle or opportunity you see?
Yeah, we'd be curious to know your take.
Thanks for tuning into the deep dive. We'll be back soon with another breakdown.